Stocks higher this morning thanks to NVIDIA doing a lot of legwork right now. But a calm in bonds and the dollar following this morning's GDP also helping to support markets. Let's check in with John Kosar joining us from Asbury Research. He's a chief market strategist. John, welcome back. Always a pleasure to have you.
Thanks. It's nice to be here. Good to see you.
Absolutely. Appreciate it. Okay, so your internal market metrics. We've been tracking these for several years now as you've been coming on our program. As I've said many times before, it's pretty amazing how well these things have worked. They continue to have been pretty telling here. Last time we spoke, you were generally positive with a heads up that we were potentially in the middle of some flux. Where are we right now? Did we flux to the more negative side this last 2-week period?
Actually, the Asbury 6, it had been green or bullish since January the 11th. It turned to negative yesterday.
Oh, wow. Okay. So
yeah,
we missed it by a couple days.
It turned negative as of the close on 2/21, which is 2 days ago. So what we sent you overnight showed 4 of the 6 Asbury metrics were red or negative. All 6 are negative now this morning.
Wow.
So that indicates that the market has become internally weak. And that shift started middle to end of last week. It started one of the Asbury 6 turned, you could see some of the dates here. We lost 2 of them, turned red on 2/16. Another 2 turned red on 2/17, which was Friday of last week. And then as of this morning, they're all red. So this is very sensitive, tactical, but what it means for right now is, the patient is weak, and the market is weak, and it's vulnerable to more near-term weakness from here.
Now, so just to make sure I heard you right there, all 6 now turned red, so a few of them changed, because we were just looking at the one that we had from the notes overnight. So the 2 that were green there, those are red now too, the rate of change for the S&P 500, the top 2. So it's pretty bearish at this point.
It is, but again, this is a very sensitive indicator. I built the Asbury 6, had to be more than 5 years ago, because it used to be, you could look at the S&P 500 and maybe look at breadth or volume and get a good day-to-day back of the envelope of what the condition of the market is. You can't do that anymore with the, the volatility from day to day. It's up 50 today, it's down 70 tomorrow. Very easy to get you to bite on a move that's not going to stick. It's going to last one day, and then they force the market up the other way, and you're forced to get back in. So there's a lot of that going on. So I built this metric and back tested it so I could determine the internal health of the market on a daily basis without focusing on the jumpy S&P 500 solely.
Okay. Now, given that the indicators are flashing red right now, where do you kind of see that momentum taking us? When you look at the charts, when you look at the relationship with some of the macro stuff, I know you pay attention also to interest rates too, of course. We're looking at a chart of the S&P. You've got some stuff highlighted on here. What do you think the important levels are, John?
Interestingly, we're right on top of them. You could see that we stalled since the beginning of February at the old highs that we made on DEAST 1 and 13. That was 4,100. So as we broke through there, tried to hold that rally, that's when you started to see the Asbury 6 start to weaken. So now we've backed off. So what we have is, you see all those lines there on the right edge. That's the 50-day moving average, the 200-day moving average, the trend line, which is the dotted diagonal line going from top left to lower right. You could see it in white on the chart. And then finally, the low that we made on Jan 19th. That cluster of 4 begins at 39.79 and it ends at 38.86. So I look at all of those as a big wall of support. The other important thing on this chart is that after several attempts, we actually broke through the 200-day moving average higher. We broke through the trend line on January the 23rd. So right now, I am looking at this pullback as the first, corrective move that we've had after the breakout in late January. So this is still, in my view, this is the early the early part, the beginning of an emerging major bullish change in trend. And that will remain in effect as long as this 39.79 to 38.86 support level holds the market on this little slide that we've had over the past couple of weeks.
I see. It's an interesting way to partition the chart within the intermediate term versus the long term. The intermediate and then the short term, of course. So the short term is weak. Asbury 6 reflects that rollover we've had, but it's a rollover in the context of an intermediate uptrend that we've been in for about 5 months now. So there's some decent time behind it. Unless we start breaking down through that trend line, and I see it too. I mean, I've pretty much had the same one on here on my own trading platform, which is roughly around 4,000. So it's kind of convenient whole number, basically. If we start breaking through there, then we start thinking about going back to the lows, John?
Yeah, I mean, you just kind of follow step by step. If we get down underneath 38.80, the next level is 37.64. That's the low that we made back right before Christmas on DC22. Underneath there, you got 36.98. That's the low from November 3rd. So they're very well-defined levels. So what we do is we make sure we know where the levels are, and then we make sure we know what the internal condition of the market is by looking at the Asbury 6, by looking at the VIX, seeing how the VIX is reacting to this. If we can hold in here within the 100 points of where we are now, we're at 40.16 now, and I see the Asbury 6 start to turn green, the VIX backs off a little bit, I would look at that as an opportunity to buy.
All right. There it is. Thanks, John, for the update. Much appreciated.
Thank you.
Mr. Kosar is the Chief Market Strategist at Asbury Research.